Right now, like as you listen to this, there is an invisible multi-million-dollar war happening.
Oh, absolutely. And it's happening fast.
Yeah, in the space of a single millisecond. It's this completely silent arms race where artificial intelligence algorithms are building massive financial fortresses.
Right. They build them, crush the human traders, and then just vanish. Well,
Exactly, without a trace. And they're doing all of this right beneath the surface of those normal flat stock charts you see on the news.
the ones that look so simple to the naked eye.
Right. So today, we are bringing that invisible battlefield into the light. Welcome to the deep dive.
Glad to be here for this one.
We've got a stack of incredibly revealing sources today. First, we're looking at an internal technical manual for a browser-based trading software. It's called 3D NXUS Meta V7.
Yeah, quite a name.
It is. And to pair with that manual, we have a really gripping case study titled The Moving Fortress: Decoding HFT Bid Attacks.
And just real quick for anyone wondering, HFT stands for high-frequency trading. We are talking about, institutional algorithms executing thousands of orders in the time it takes you to blink.
It's wild. But I want to make a promise to you, the listener, right up front. You do not need to be some Wall Street quant or like a math PhD to find this fascinating.
Definitely not. The core concepts are actually very visual.
Yeah, they are. Our mission today is to decode how these algorithms use three-dimensional spatial architecture to manipulate prices. And, well, how new tech is allowing human traders to finally put on the 3D glasses, so to speak, and see the trap before it snaps shut.
It's basically making the invisible visible.
Okay, let's unpack this. Before we can truly grasp how these algorithms launch an attack, we really have to talk about the flaw in how most of the world looks at financial markets.
You mean the standard charts?
Right, those traditional 2D candlestick charts, the ones showing red and green lines going up and down, they're essentially just an autopsy report.
That's a great way to put it, an autopsy report. Because a candlestick chart, it only shows you the hindsight of a price movement.
Just the aftermath.
Exactly. It tells you where the price was and where it ended up over a certain time.
Yeah.
It's just a historical record. But what it entirely obscures is the microstructure data.
Okay, let's define that for a second. Microstructure data.
Think of it as the individual molecules of the market.
Molecules, okay.
Yeah. Before a trade ever becomes a line on a graph, it starts as an intention. A bid to buy or an ask to sell. Microstructure is the real-time collision of all those millions of unexecuted intentions.
Wow.
And the 2D chart hides all of that pressure. It tells you absolutely nothing about the underlying forces that actually pushed the price or the walls blocking it from falling.
It's like looking at a flat footprint in the mud and trying to guess, I don't know, how heavy the person was or how fast they were running.
Right, or what their heart rate was. You just can't know from a footprint.
Exactly. But that brings us to our first source, the 3D Nexus Meta V7 platform. Reading through this manual, the capabilities are just staggering.
It's quite a leap from traditional tools.
It really is. It takes the order book, which is usually just this rapid-fire, headache-inducing list of numbers, and it turns it into a fully rendered 3D web environment.
And the accessibility is key here.
Yes. You don't even need a supercomputer to view it. It requires zero installation. You literally just open an HTML link, and it's running in your browser in 30 seconds.
Pulling live data from over 18 different sources.
Crypto, traditional futures, everything. And the manual details 5 distinct visual modes.
And we should stress, these aren't just for show.
Right. They aren't just aesthetic choices. They're highly functional lenses. Like, I was looking at the tunnel mode.
Oh, that one is intense.
Yeah, you are literally flying through a 3D tunnel of the market, and the bid and ask orders rise up around you like skyscrapers. At first, it sounds like a video game.
Yeah, it looks like one too.
It does. But functionally, if you are a trader flying through that tunnel, you can instantly gauge market density. You aren't reading numbers anymore.
You're just seeing the obstacles.
Right. You see a massive wall of digital skyscrapers blocking your path, and your brain intuitively knows, okay, the price is going to struggle to get past that.
It gives physical mass to digital intent. And you also have the footprint mode, which shows the actual volume traded at specific price levels rather than just time passing.
Okay, yeah. And then there's the X-ray mode, which I found fascinating.
Oh, X-ray is crucial. It allows a trader to visually strip away the top layers of the order book.
So you can see what's underneath.
Exactly. You can spot hidden institutional layering stacked deep underneath the current price.
Wow. And then there's canyon mode. That's where the buyers and sellers face each other like massive cliffs across a valley, right?
Yes. You can look at the valley and immediately sense if the buyer's cliff is, say, twice as massive as the seller's cliff.
But here's where I was really trying to synthesize the value of this tool. The text mentions a feature called the Aggregate Multi-Exchange V2.
What's fascinating here is how it addresses the problem of fragmented vision.
Fragmented vision.
Yeah, so an asset like Bitcoin, right? It doesn't just trade on one platform. It trades on Binance, Bybit, OKX, and dozens of others simultaneously.
Wait, so if I'm looking at 5 different crypto exchanges, isn't this aggregate feature basically acting like a pair of noise-canceling headphones?
That is the perfect analogy.
Okay, because the manual says it weights the different venues by liquidity, it deduplicates the trades in real time, and it filters out ghost data.
Like if an exchange freezes for 5 seconds.
Right, so I only see the true unified market floor.
It hands the trader a consolidated, omniscient view of the depth. It even issues divergence alerts if prices drift apart by just 0.3% between exchanges.
I have to admit, though, reading through all this gave me a sense of genuine intimidation.
How so?
Well, because even with the noise canceled out, if I'm sitting there looking at a 3D canyon of literally millions of moving variables, pulling from 5 different exchanges in real time, I mean, human eyes just can't process that much raw data.
No, of course not.
It doesn't matter how pretty the 3D skyscrapers are. Microstructure data moves way too fast for biological reflexes.
Which is exactly why the visual interface is only half of the equation here. The source material introduces the true engine behind the platform.
The AI brain.
Exactly. An autonomous AI swarm and a quant engine. The trader isn't expected to calculate the probabilities. The machine does it for them.
This is where the tech specs in the manual go from impressive to borderline terrifying. Nexus V7 uses an AI swarm made up of 5 specialized agents.
And the hardware running them is massive.
Yeah, they rely on Cerebra's hardware. For anyone unfamiliar, these are wafer-scale, incredibly massive AI chips.
Truly huge.
And they're running models like Llama 3.370B and Wen 3.235B. We are talking about 70 billion parameter models executing sub-second inference.
It's an insane amount of computing power.
Why does a trading platform need that level of heavy metal?
Because in high-frequency trading, speed is the weapon. If your analysis takes 2 seconds to process, the market has already moved.
Your insight is totally worthless by then.
Right. The Cerebrus chips allow the AI to think, synthesize, and react in milliseconds. And if those chips hit a rate limit during an extreme market event, the system has an automatic failover to Grok hardware.
Wow. Ensuring zero downtime, they have absolute redundancy. Let's look at the specific agents in this swarm, because they all have designated targets, don't they?
They do. You have the spoof warden, for example. It tracks how often massive orders are placed and immediately canceled to spot manipulation.
And my personal favorite, just for the name, the iceberg assassin.
It's a great name.
Its entire job is to scan the order book across 4 consecutive snapshots. It's looking to catch hidden orders that are secretly reloading behind the spread.
The swarm also utilizes the Delta Hunter.
What does that one do?
It specifically tracks the real-time imbalance between aggressive buyers and aggressive sellers, sniffing out directional momentum before it reflects in the price.
But, I mean, 5 AIs shouting different alerts at you would just cause decision paralysis, right?
Well, definitely. Which brings us to the consensus overlords.
I just love how ominous the naming conventions are here.
It really sets the tone. But the overlord takes the findings from all those agents, the iceberg assassin, Delta Hunter, spoof warden, and it generates a single live probability verdict.
And it even uses a vocal oracle to speak to the trader out loud.
Yeah, literally whispering probabilities to you. But the crown jewel of this architecture is the Prediction Oracle V2.
Right, the forecasting tool.
It projects the probability of price movements across 6 simultaneous horizons. It runs predictive models live, forecasting 5 seconds, 10 seconds, 30 seconds, all the way up to 2 minutes into the future.
I was looking at the math powering this, what they call the quant engine. It relies heavily on 2 key metrics to keep traders out of traps.
Yes, the math is fascinating.
The first is VPI, the volume synchronized probability of informed trading. From what I understand, VPI is essentially a toxicity meter.
That's spot on. It measures the ratio of uninformed retail flow against the informed institutional flow.
So it spots the big players.
Exactly. Institutions leave a specific mathematical footprint when they enter a market.
So a VPI spike is basically like noticing the water suddenly draining away from the beach. The ocean looks calm to the naked eye, but the underlying system is telling you a tsunami of institutional money is already on the way.
get to high ground.
Yeah, exactly.
The system literally suppresses your trading signals during these spikes, warning you not to jump in.
Okay, and what about the second core metric, the Hawkes branching ratio? Let's break that down because it deals with trade clustering.
Right. The Hawkes model asks a very specific mathematical question. It asks, is this current trade happening organically, or is it triggering a cascade of subsequent trades?
It's the difference between tossing a match into a soaking wet forest versus a bone-dry one, isn't it?
Great analogy. A low ratio means the market is wet, trades hit the book and just fizzle out.
But a high ratio?
Anything over 0.85 means the forest is dry. One trade is going to spark 10 more, and you are in an avalanche risk zone.
If you consider the advantage this creates, I mean, think about this. A normal retail trader might be looking at a flat line on a screen, guessing based on historical patterns.
Just crossing their fingers.
Meanwhile, an institution, or anyone wielding this Nexus tool, has a supercomputer whispering the mathematical probability of an avalanche into their ear before the first snowflake even falls.
That's a completely different game.
Right. And if you've ever tried to buy a stock or a crypto token and the absolute second you clicked buy the price inexplicably shot down and stopped you out, you've probably been the victim of the exact algorithmic traps we're talking about here.
Oh, happens to retail traders all the time.
So what does this all mean in practice? We have this supercomputer predicting toxic flow in milliseconds. What does that toxicity actually look like in the wild?
That is exactly what the SpaceX token case study maps out.
The SPCXUSDT attack.
Yes. The breakdown of that attack illustrates algorithmic pressure perfectly. It shows how the invisible structure dictates the visible price.
The source material uses a brilliant analogy for this. To understand this high-frequency attack, you have to stop thinking about a buyer frantically purchasing up the market to raise the price.
That's the old way of thinking.
Right. Instead, the algorithm builds a hydraulic jack made out of limit orders underneath the market.
And just so we're all on the same page, a limit order is essentially a trader planting a flag in the ground.
Saying, I'll only buy at this exact price.
Right. Not a penny more, and I'll wait until the market comes to me. And the collection of those limit orders waiting to be triggered is called resting liquidity.
Resting liquidity, okay.
The algorithm uses that resting liquidity to mechanically force the price up. The first phase of this operation is deployment.
Setting the trap.
Exactly. The market was trading just below a stubborn resistance level, a price ceiling, basically. Out of nowhere, the 3D Nexus radar detects a massive anomaly.
These enormous blue columns of liquidity just materialize directly below the current price. And the source really stresses the speed of this deployment.
It's instantaneous.
Yeah, these orders didn't sit there all day. They appeared in milliseconds, placed surgically close to the action.
Following the deployment is the clustering phase, because a single giant order wall is actually quite vulnerable.
Oh, really?
Yeah, if sellers coordinate, they can blast right through a single wall.
So the algorithm doesn't build a single wall. It builds a multi-level staircase. It distributes this massive liquidity across several adjacent price levels,
creating a deeply intertwined defensive zone.
Right, the sellers have no choice but to interact with it.
Which brings us to the ultimate test of the structure, the reloading phase.
Phase 3.
Exactly. When normal organic liquidity is hit by aggressive sell orders, it is consumed, it shrinks. But in this case study, as sellers attack this massive new floor, the size decreases briefly as the orders are filled.
And then it rapidly reloads. The liquidity instantly regenerates.
It just absorbs the hits.
It's hit, reduce, reload, hit again, reload again.
If we connect this to the bigger picture, a massive order sitting passively on a book is just a static picture, but a structure that actively and instantly rebuilds itself while under fire. That is a process. That is the moment passive accumulation transforms into an aggressive defense.
The algorithm creates an inexhaustible floor. The hydraulic jack is in place, and the trap is completely set. The sellers are just exhausting themselves punching a wall that refuses to break.
And in the market, failure to break a floor is incredibly potent information.
Oh, totally. The sellers realize they are trapped. This is phase 4. The short sellers who bet on the price falling, they start to panic and buy back their positions.
Momentum algorithms sense the block downside and jump in to buy too.
So the HFT algorithm barely has to buy anything aggressively itself. Its mere refusal to let the price fall forces the rest of the market to push the price up for it.
It's brilliant. And once the sellers buckle, the algorithm initiates phase 5, The ratcheting process.
The ratcheting
The
process.
price begins to climb, but the massive defensive wall doesn't stay at the bottom.
No, the algorithm cancels the lower support levels and rebuilds them higher up. The fortress is mobile.
It crawls beneath the market.
It absorbs the sellers, lets the price advance, cancels the floor, and rebuilds it higher. It physically squeezes the price upward, compressing the space until the market is slammed into that ceiling.
Building the pressure.
Here's where it gets really interesting. Phase 6. We reach the breakout. The price finally shatters that resistance ceiling, moving from $207.30 up to $208.
No.
The absolute millisecond the price crosses that threshold, the massive multi-level regenerating blue structure completely vanishes.
Gone.
Just gone. The case study notes, quote, "The scaffold is removed once the building has crossed the gap."
The objective was met. The algorithm provided the structure to absorb the selling pressure and facilitate the breakout.
Right.
Once the price entered the new higher zone, the hydraulic jack was just dismantled.
Now, I was reading this and a glaring question hit me. We hear about market manipulation in the news constantly. Wait, isn't this just spoofing? Isn't it just illegal fake volume?
That is a crucial question. The case study makes a vital distinction here. Spoofing is fundamentally a trick.
A trick.
Yeah, is the act of placing a massive order to scare other participants with the strict, programmed intention of canceling that order before it ever executes. Spoofing is an illusion.
But the moving fortress was not an illusion.
Precisely. This was aggressive liquidity support. The core difference is execution. When the sellers attacked those massive blue walls, the walls didn't run away.
They actually took real hits.
Exactly. The algorithm deployed actual capital to absorb real sell orders and maintain that floor. It was a heavily capitalized active defense that forced the market's hand through genuine mechanical pressure.
Not deception.
Right, not deception.
Wow. So, to synthesize what we've uncovered today, what looks to the average person like a simple triumphant green candle on a flat 2D chart is actually a complex, multi-layered spatial war happening in the depths of the order book.
A six-phase war, yeah.
An algorithmic predator deploys a moving fortress, absorbs the attacks, ratchets the market upward, and then vanishes without a trace. We only know it happened because tools like the 3D Nexus Meta are finally taking off the blinders and rendering the invisible visible.
This raises an important question for anyone navigating data today.
Oh.
We are entirely conditioned to look at the surface result. We look at the price going up or the trend line pointing north. But we have to fundamentally shift our perspective.
That's what's underneath.
Exactly. We have to ask, what underlying architecture is being built to force that result? The surface almost never tells the whole story.
It really doesn't. And I want to leave you, the listener, with a final thought to chew on. We've spent this entire deep dive looking at financial markets. But at the end of the day, an order book is just one very specific type of data stream.
Just one of many.
Right. If autonomous AI can build invisible digital scaffolding to manipulate the trajectory of global finance right under our noses, what other digital environments in our daily lives are being steered the exact same way?
It's a slightly terrifying thought.
It really is. Think about your social media feeds determining what goes viral. Think about the dynamic algorithms pricing your next flight or hotel room.
Or the search results dictating what product you buy.
Exactly. Are those environments actually organic terrains, or are they being shaped by invisible ratcheting walls that we simply don't have the 3D glasses to see yet?
It's entirely possible we are all walking on moving fortresses every time we log on.
Just like that invisible battlefield, you might not see the mountains and the valleys, but the terrain is shifting under your feet all the same. Thanks for diving deep with us.